Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, the focus was once again on the Trump administration's tariff policies, as reciprocal tariffs went into effect last Wednesday. Reportedly calculated based on each trading partner's own tariffs and other non tariff barriers to trade, including currency manipulation, as well as the country's trade deficit with the U.S. The reciprocal rate assigned to many of the country's key trading partners jumped substantially. Although just 1 week after the announcement, the president offered a 90-day pause for most countries, at least those that didn't initiate a retaliatory response, dropping country specific tariffs down to a universal 10% rate for all trade partners except China. The reciprocal rate assigned to China stands at 34%, which came in addition to the 20% rate already imposed on all Chinese goods as of March 4th, totaling 54%, which more recently jumped to 125% and then 145% as of last Thursday, after China announced retaliatory tariffs of their own on U.S. goods at 84% beginning April 10th, before upping it to 125% on Friday. The relationship between the two nations is complex, to say the least. China heavily relies on U.S. consumers to buy Chinese made products, with roughly 15% of Chinese exports bound for the U.S. Meanwhile, the U.S. is dependent on China for roughly 13% of our own imports, suggesting at least in the near term there will be some expected difficulty in terms of finding alternative suppliers, potentially resulting in cost increases and supply chain disruptions. The European Union also responded to U.S. levies last week, approving tariffs to impact roughly 23 billion of U.S. goods, including diamonds, agricultural products, poultry, and motorcycles. The latest comes in response to the Trump administration's move to add a 25% tariff on the region's steel and aluminum exports. A statement from the European Commission noted that such retaliatory measures could be removed at any time, quote, should the U.S. agree to a fair and balanced negotiated outcome. As the international community continues to negotiate through a historic adjustment to U.S. trade policy, the market continues to face downward pressure as investors brace for a worst case tariff fueled recession scenario. But while a downturn in growth is likely in the first half, a recession in and of itself is not a foregone conclusion. Nevertheless, according to Bloomberg data, the market puts the risk of recession around 30%, with market players pricing in as many as 4 rate cuts from the Fed, potentially taking the upper bound of the federal funds rate to 3.5% by year end. While sluggish growth remains a likelihood, cost pressures are another component of risk resulting from the latest trade initiatives. According to the latest March FOMC meeting minutes, for example, Fed officials are increasingly concerned about persistent upward momentum in price pressures, as well as the threat of a combination of the two, slower growth and elevated costs, potentially resulting in stagflation. As such, following 2 consecutive meetings on the sideline, at least some officials appear prepared to remain on hold for some time longer, even in the face of a potential slowdown in the labor market, to minimize the risk that tariffs will cause a quote persistent rise in inflation. Again, the Fed was relatively positive in its latest assessment of the U.S. economy in March and optimistic the potential negative impact from tariffs will prove transitory, repeating a scenario more akin to 2018 when long-standing inflation failed to materialize. But not all Fed officials are convinced. Chicago Fed President Austin Goolsbee, for example, warned of a persistent inflationary scenario as seen in 2020. Speaking to CNN last week, Goolsbee noted there is good reason for fear that supply chain disruptions and further inflationary pressures could resemble more of a post-COVID scenario when inflation spiked to double digits. Additionally, Minneapolis Fed President Neel Kashkari reiterated the need to keep inflation in check amid changing fiscal policy, noting the bar for additional rate cuts has risen. In an essay published on the Minneapolis Fed website, Kashkari argued the Fed should be less inclined to lower rates to provide support on the growth side, given the likely inflationary impact from tariffs on already elevated cost pressures. Speaking of inflation, also last week, investors had an opportunity to take a fresh look at the real inflation data, beginning with the Consumer Price Index on Thursday. The headline CPI unexpectedly fell 1/10 of a percentage point in March, the first monthly decline since May of 2020, and gained 2.4% year over year, a tenth of a percentage point less than expected, and the second month of cooling after 4 consecutive months of acceleration. In the details of the report, other goods and services prices rose a sizable 1%, while education and communication costs increased 0.3, and shelter costs, while still accelerating, posted a cooler rate of ascent. On the weaker side, recreation and commodities costs fell in March, with energy prices dropping an impressive 2.4%, along with airline fares dropping a whopping 5.3% in March, the largest monthly decline since August of 21. Excluding food and energy costs, the core CPI also rose less than expected, up 1/10 of a percentage point for the month and 2.8% on an annual basis, cooling from a 3.1% pace in February and now marking the smallest annual increase in 4 years. Additionally, looking at another iteration of inflation, the supercore, defined as core services excluding housing, fell outright, down 2/10 of a percentage point in March, following a 2/10 rise the month prior, and increased 2.9% over the past 12 months. While still almost a full percentage point above the Fed's intended target of 2%, this marks the smallest annual increase since March of 2021. Turning to producer prices, the PPI also unexpectedly fell, down 4/10 of a percentage point in March, the largest monthly decline since October of 23. Year over year, producer prices rose 2.7% in March, significantly less than the 3.3% gain expected and the smallest annual increase in 6 months. In the details of the report, goods prices fell nearly a full percentage point, reflecting a steep decline in energy prices, off 4% for the month, the second consecutive monthly decline and the largest 1 month drop in over a year. There was also weakness in finished goods, off nearly 4%, along with a more than 2% decline in food costs. In fact, energy costs alone have retreated markedly over the past 3 months, falling over 20% or nearly $19 a barrel from a January peak of just over $80. At the current level, trending near $60 a barrel, this is the lowest level in 4 years. Thus, excluding lower food and energy costs, the core PPI also fell outright for the month, but a lesser 0.1%, still, however, the first monthly decline since July. Over the past 12 months, the core PPI rose 3.3% on an annual basis, 3/10 of a percentage point less than expected, and marking a 6 month low. Bottom line, a back-to-back cooler than expected read on consumer and producer prices underscores the improving inflationary picture at the start of the year. A step in the right direction towards slower price growth, however, is somewhat of a double-edged sword, as it reflects both a structural, albeit modest, loss of momentum from the fourth quarter, as well as a material decline in activity as businesses and consumers continue to pull back in anticipation of potential negative implications from the latest White House policy initiatives. Going forward, while increased layers of tariffs risk driving prices higher, subdued costs of many commodities, including energy, already reflecting a cooling of demand, may help temper the pass-through of additional cost pressures. Furthermore, amid heightened uncertainty and still ample unknowns, the perception of significant adjustments to international trade policy may prove worse than the reality, particularly if negotiations prove fruitful in reducing implementation or further retaliatory escalations, while resetting unfair trade practices that have been in place for decades. Of course, that being said, a global reset will not happen overnight. It will take time. And as such, broadly speaking, ongoing barriers to the free flow of goods and services on the international stage will, at least in the near term, result in an ongoing pullback of top line activity, likely driving growth below 1% in the first half of the year, while pushing inflation nearer 3% through year end. The risk of recession also remains a real, very real possibility, but is not a foregone conclusion. Continuing to reflect rising concerns and further upside inflationary risks stemming from tariffs, the latest small business optimism report fell sharply again in March, losing ground for the third consecutive month. The NFIB Small Business Optimism Index fell over 3 points to a reading of 97.4 at the end of the first quarter, surpassing the expected decline and marking a 5-month low. According to the details, 88% of firms report no plans to hire within the next 3 months, while over 90% reported that now is not a good time to expand their business. At the same time, the NFIB Uncertainty Index fell 8 points to a reading of 96 in March. While nominally still elevated, the modest decline is a welcome retreat after reaching the second highest reading on record the month prior. Meanwhile, consumers also continue to express growing concern regarding fiscal policy, inflation, and the outlook for their personal financial conditions. The University of Michigan Consumer Sentiment Index, for example, fell more than 6 points to a reading of 50.8 in the preliminary April report, surpassing the expected decline and dropping to the lowest level since June of 22. In the details of the report, a gauge of current conditions fell over 7 points to the lowest reading in about 3 years, and a gauge of future expectations fell nearly 5.5 points to a reading of 47.2, the lowest since 1980, as consumers brace for further uncertainty and potentially higher inflation. In fact, a measure of short-term inflation expectations soared 180 basis points in the latest report, rising from 5% in March, already a more than 2-year high, to 6.7% in the preliminary April report, the highest since 1981. A measure of longer-term inflation expectations also increased, albeit far less, up 30 basis points to 4.4%, still, however, the highest since 1991. This week, the economic calendar begins tomorrow with a look at the April Empire Manufacturing Index, along with import and export price indices for March. Later in the week on Wednesday, weekly mortgage applications will be released, along with the first highlight of the week, the March retail sales report. After a smaller than expected 0.2% rise in February, albeit a 2-month high, retail sales are expected to rise a more substantial 1.5% in March, potentially marking the largest increase since January of 23. Year-over-year, retail sales are expected to increase a solid 4.2%, potentially marking the strongest pace since December. Additionally, on Wednesday, we'll take a look at industrial production and capacity utilization for March, ahead of weekly jobless claims on Thursday, along with March housing starts and building permits. Recall last month, starts fell nearly 3% on an annual basis, while permits declined nearly 7%. This month, starts are expected to rise 8.5%, potentially marking the largest annual increase since February of last year, while permits are expected to remain in the red, albeit at a reduced loss of 2.3%. Also on Thursday, the April Philadelphia Fed Business Outlook Index will be released, with no additional releases on Friday as the market is closed in honor of Good Friday. And finally, on the FedSpeak front, we'll hear from several officials throughout the week, including Philly Fed President Patrick Harker and Atlanta Fed President Raphael Bostic later today. We'll also hear from Cleveland's Fed President Beth Hammack and Kansas City Fed President Jeffrey Schmid later on in the week on Wednesday, and from San Francisco's Daly on Friday. With growing trepidation regarding the impact of tariffs on the economy and inflation, the market will be listening closely as to the Fed's assessment of the sustained impact and any potential adjustments to policy in the coming months. And with that, I'd like to thank you for starting your week with Stifel.